Illustration number 5. Mrs. Sahani Enterprises acquired a printing machine for rupees 40,000 on July 1, 2014 and spent rupees 5,000 on its transport and installation. So the overall value being 45,000. The date of acquisition being 1st July. So this asset is eligible for proportionate depreciation, not for full year's depreciation. Another machine for rupees 35,000 was purchased on January 1, 2016. Depreciation is charged at the rate of 20% on written down value. Prepare printing and machinery account. Printing machine account. Okay. Okay. I assume the year end being 31st March, though not mentioned, I assume this way. 31st March. Printing machine account. So we have two machines here. On 1st July 14, to bank. The value of asset purchased being 45,000 including installation charges. And the other asset is purchased 2 years later, 1st January 2016. This year gets over on 31st March 2015. 31st March 2015, I have to provide depreciation, by depreciation. The depreciation here being 45,000 and applicable rate of depreciation here being 20%. Number of months eligible for depreciation being from the date of purchase 1st July to 31st March, we have 9 months, so you have to calculate the depreciation for the 9 months. This value being 6,750. Am I right? 6,750. Now, after this depreciation, the balancing figure being, you have to tally this and find out the balancing figure. 45,000. The balancing figure here being 38,250. In the next year beginning, 1st April 15, to balance brought down. 38,250. This year gets over by 31st March 2016. But halfway through, we purchase one more asset on 1st January. So 1st January 16, to bank, we purchased another asset for rupees 35,000. Now for the year end, 31/3/16 by depreciation. I will work out the depreciation separately here. For the asset number 1, 38,250 was used to full year, so eligible for full year's depreciation at the rate of 20%. Yes, tell me what's the value here? This value 38,250 into 20%, 7,650. Second asset also purchased sometimes later for 35,000. This will also be for depreciation, subject to depreciation, but eligible for only 3 months as it is purchased only on 1st January, ends on 31st March, 3 months depreciation will be calculated here. So 35,000 into 0.2 divided by 4, the answer being 1,750. The overall value being 9,400. You do a working note like for calculating the amount of depreciation year after year. Straight away getting the depreciation may be Bit complicated here in the case of WDV method, so it's better to calculate separately here. 9,400. 9,400. Now close tallying this. 73,250. 73,250. Balance carried on. 63,850. 63,850. And here balance brought down. 1,416. 63,850. For the year end 31/3/17, by depreciation, we have two assets now in the beginning. That all the two assets used for the entire year. So both the assets will be eligible for full year's depreciation at the rate of 20% on the WDV value. The WDV value of both the assets put together 63,850. For that 20% being 12,770. Am I right? 12,770. Now finish up tallying this. 63,850. 63,850. Here this is being balanced. The balance amount being 51,080. I'll write it down the next year beginning as balance brought down at the rate of rupees 51,080. Okay. Come on, make a note of it.